Okay, so welcome to our final topic in this course, which is about going concern reporting. So if you remember back to the last class where we discussed audit reporting on financial statements, I explained that usually auditors issue unqualified opinions, but very often they issue an emphasis of matter with the unqualified opinion. And the most common form of emphasis of matter is where there is a going concern uncertainty. In other words, the auditor is warning the users of the financial statements that there's a distinct possibility that the company may cease to be a going concern within the foreseeable future. So this is kind of illustrated here in this little cartoon, right? We're really dealing here with companies that are in financial distress, right? And so this person saying, well, I've solved our company's financial problems by removing the red ink cartridge from the printer. Okay, so just a little joke. Okay, so this is the topic for today, going concern. What are the learning objectives? Well, first of all, you should be able to explain what is the going concern assumption. This is a fundamental assumption that underlies the preparation of financial statements. So what is the assumption? And secondly, why is that assumption so important to financial statement users and to auditors? Then thirdly, what are the factors that auditors should take into account when assessing going concern? Okay, so what are the indicators that a company may be less likely to remain a going concern? And what are the mitigating factors that could indicate the company may be able to get through its financial problems and survive? Okay, so we'll have some discussion on that. And then finally, what are the recent changes to US GAAP on going concern, and how do these changes affect auditors? Okay, so those are the learning objectives for today's class. Here is the seminar outline. The objectives, again, are stated here. The class reading, as always, you should read through the outline because the outline has the questions and the student presentation for today's topic. Secondly, you should look at the PCAOB inspection report that was issued to McGladrey and Pullen in 2010. You'll need to read this in order to be able to answer question 3. So I put this as required reading. The third reading is just optional, right? You don't have to read this. This is Auditing Standard 2415, which is a guidance for auditors on how to assess an entity's ability to continue as a going concern. I will be largely talking about this in the class anyway, so that's why I put this as optional. Right? You don't need to read this unless you want to. And then there are 2 additional readings for the student presenters, which are optional for everybody else. The first one is about the presentation of financial statements under the going concern assumption. And then the second one is PCAOB practice alert relating to the auditor's consideration of a company's going concern status. Okay, so those are 2 readings mainly for the presenters. So what are the questions we're going to cover in the class? Well, question 1 is about a company called ABC Corp. I want you to suppose that you're an audit manager and the audit partner has asked you to prepare an audit plan for the company. The company has obviously some financial distress issues because that's why it's on the going concern topic. So you can read through these pieces of information. Here's an extract of the financial statements, including the unaudited financial statements for the year that you are going to audit. And the questions are, first to A, what are the key indicators that ABC may be encountering a going concern problem? B, what are the limitations with using the company's financial statements to assess the severity of the going concern problem? So in other words, what are the limitations of analytical procedures for assessing going concern? C, what additional information would you need to evaluate more fully the significance of the going concern problem? So what other information would you like to see that is not provided for you in the case? D, assess the risks of material misstatement in the following accounts: property, plant and equipment, sales, accounts receivable, and inventory. Okay, so how high do you think the risk of misstatement is in those accounts, given the information provided? And then finally, part E, comment on the CFO's offer to increase your audit fee. All right, so that's for question 1. Question 2 is talking about the difference between disclosing a going concern issue as a critical audit matter versus an emphasis of matter. Okay, so I'm going to get you to look up 2 audit reports. One was issued to a company called Poverty Dignified, and the other is issued to TerraTech. Okay, actually, you don't need to look up the reports. I just remembered I've got them here for you. You just need to read through them. Okay, so I've downloaded these reports for you. Just read through them. Tell me which one discloses the going concern problem as a critical audit matter, which one discloses the going concern problem as an emphasis of matter. Okay, so that's very easy. You just read through the reports. Then part B, what's the difference between a critical audit matter and an emphasis of matter? So that goes back to what we talked about in the previous class. And which type of disclosure do you think would be viewed more negatively by investors? Okay, so do you think investors would be more concerned about going concern emphasis of matter or going concern critical audit matter? Okay, so have a think about that. That's for question 2. And then question 3 is relating to the PCAOB inspection report that was issued to McGladrey and Pullen. McGladrey and Pullen is one of the mid-tier audit firms. Okay, so it has an inspection report of 2010. The PCAOB criticized McGladrey and Pullen for the way that it was auditing the going concern assumption, and I want you to tell me what were the deficiencies the PCAOB noted. Okay, so you need to read through that report and you'll find that information. Then we have some multiple choice questions, and then the seminar outline finishes with the material for the student presentation. So I have some articles here for presenters and for the rest of you to read. Actually, one article, right? This one here from Accounting Today. Nice short article. And then a couple of questions. First of all, what is the going concern assumption? When should the financial statements be prepared on a going concern basis? When should they be prepared on a liquidation basis? That's the first one. And then the second one is, how does the FASB's accounting standards update affect financial reporting disclosures about going concern? And how do you think this recent change to US GAAP affects auditors? Okay, so that will be covered in the student presentation, and hopefully you'll also have some questions for the presenters to ask. Okay, so that's the seminar outline. Let's go back to the PowerPoint slides. So first of all, the going concern assumption, right? What is it? Well, the financial statements are prepared on a going concern basis. The going concern basis assumes the client will remain a going concern for the foreseeable future. What does it mean to remain a going concern? Well, it means that the company can continue trading without a significant curtailment in the scale of its operations. Okay, so in other words, the company won't have to close down most of its operations, or it won't have to go into bankruptcy. All right, so that's the going concern basis. That's the assumption, right, that the company will remain a going concern. How long is the foreseeable future? Well, it's 1 year following the issuance of the financial statements. So the auditor has to consider the likelihood that the company can remain a going concern for the next year. Now, if there's substantial doubt about the going concern assumption, the auditor should disclose this in an emphasis of matter paragraph. Okay, so we saw an example of this in the previous class, right, if you remember question 1, but here's another example here. Right, here's an added explanatory paragraph where the auditor says that this company has a going concern problem. So the first sentence says that we're assuming Fairfax will continue as a going concern, but as noted in note 11 to the financial statements, there's some doubt about this because the company has recurring losses from operations, has a net capital deficiency. This raises substantial doubt about the company's ability to continue as a going concern. Management's evaluation and plans are described in note 11. The financial statements do not include any adjustments that might result from the outcome of this uncertainty. So in other words, if the company doesn't remain a going concern, if, for example, it goes into bankruptcy, then the financial statements are not going to reflect the company's value. And then it says our opinion is not modified with respect to this matter. Okay, so this is the explanatory paragraph note that the auditors provide in the audit report. Notice that the company has to disclose this in the notes to the financial statements. If the company didn't disclose this, then there would be an accounting disagreement, in which case the auditor would issue either an except for opinion or an adverse opinion. Okay, but in this case, the auditor, in this case, the company has disclosed this in the note, and so the auditor can issue an unqualified opinion, but with the extra explanatory paragraph. Okay, so why is all of this important to investors or financial statement users? Well, the reason is they need to know whether there's substantial doubt about the validity of the going concern assumption, because if the company's assets have to be liquidated, this is going to affect the value of those assets, right? So why is that? Well, generally the going concern values of assets are greater than their liquidation values. Perhaps the easiest way to think about this is, imagine you're walking down the street and you see a shop that says, liquidation sale or fire sale, right? What that means is that this shop is trying to sell its assets, its inventory, quickly, right? And that means usually that asset will be sold at an unusually low price. Okay, so in a fire sale or a liquidation sale, the value that the company gets from selling its assets is usually less than the value that is assumed under the going concern assumption. So a fire sale is a sale of assets at an unusually low price. Typically, this is when the seller of the asset is facing bankruptcy or is actually already in bankruptcy. Okay. So that's why it's important to investors. Investors need to know whether it's likely that the company is going to have to sell off its assets quickly and cheaply. Why is this important to auditors? Well, when there's substantial doubt about the going concern assumption, then the auditor is required to issue this emphasis of matter paragraph in the audit report. If the auditor fails to provide that additional paragraph and then the company goes bankrupt, the auditor faces a higher likelihood of being sued or being criticized in the media and losing reputation. Right? So if a company goes bankrupt and the auditor hasn't warned financial statement users that there is a potential going concern issue, then it's more likely that the auditor is going to suffer some penalty from litigation or from reputation loss. Okay, so that's why it's important for auditors. In addition, PCAOB inspection reports will sometimes criticize auditors for not evaluating the company's going concern status in the proper way. So an example of this can be seen in question number 3, where we'll look at the inspection report that was issued to McGladrey and Pullen. Okay, there were some audit deficiencies noted there in the way auditors evaluated the company's going concern status. So what I'm going to do now is talk to you about the evidence, right? How often do companies receive these types of going concern opinions, right? How often do auditors disclose emphases of matter because of going concern issues? Well, it turns out that about 16% of SEC registrants receive going concern emphases of matter opinions. This is historically the case. Of course, at the moment, as we're going through COVID, this percentage is considerably higher, right? I think it's currently around 25% at the time of recording this video. Okay, but historically it's around 16%. So the percentage of, in addition, the percentage of going concern opinions tends to be much higher at smaller companies, right? Small companies are more likely to end up being in financial distress. They're more likely to go bankrupt. So naturally, they tend to be more likely to receive going concern opinions, whereas larger companies tend to be more stable, more financially healthy. They more rarely receive going concern opinions. 60% of SEC registrants who receive a going concern opinion in the year prior sorry, I'll say that again, 60% of SEC registrants do receive a going concern opinion in the year before they go bankrupt, right? So in other words, if you look at all companies that go bankrupt, and then you look at the year before the company goes bankrupt, the probability of receiving a going concern opinion is about 60%. So the majority of companies that go bankrupt do receive going concern opinions. In other words, auditors usually seem to be doing the correct thing in issuing the going concern opinion. On the other hand, 98% of SEC registrants do not go bankrupt within 1 year of receiving a going concern opinion. So if you look at all the companies that receive a going concern opinion, the vast majority do not go bankrupt within a year. All right, only 2% do. 98% do not. So what that suggests is that auditors, at least in the US, are quite cautious, right? They tend to issue going concern opinions, even if there isn't a very high likelihood of a company going bankrupt. Right? As I say, only 2% actually do go bankrupt after receiving a going concern opinion. So it's kind of interesting. Here's a table which illustrates this evidence that I've just told you. So as I say, around 16%, shows here 15.9, 15.9% of companies receive going concern opinions. You'll notice that the percentage of companies receiving going concern opinions was relatively low in the early 2000s, so it's around 9%. And then after the Sarbanes-Oxley Act, it's kind of been stable at around 16, 17%. Okay. At the moment, in 2020, it's considerably more than 16%, and that's a result of the COVID panic. Okay, so that's for the full sample. And then if we split firms into large, small, and medium size, what we find is that the small companies tend to receive more going concern opinions. So if the market cap is less than 75 million, I've chosen 75 million here because this is the cutoff for determining whether the company is an accelerated filer, right? If it's below 75 million, it's relatively small. 36% of companies receive going concern opinions. So that's pretty high, right? More than a third. For companies that are more mid-size, right? If their market cap is greater than 75 million, but less than 500 million, the percentage receiving going concern opinions is just over 3.5%. And then if we look at really large companies, the ones with market cap greater than 500 million, it's tiny, right? It's 1/3 of 1%. So you see here, there's a very strong relationship between the size of the company and whether it's going to receive a going concern opinion. The super large companies very rarely receive going concern opinions, whereas the relatively small companies are about 100 times more likely to receive going concern opinions, right? 36% here compared to 0.33% for large companies. Okay, and then we can look separately at companies that go bankrupt and companies that survive. How often do they receive going concern opinions? So as I mentioned before, if you look at just companies that go bankrupt and then you look at the year before they go bankrupt, what type of opinion do they receive? Around 60% do receive a going concern opinion, right? So that's more than half. So in more than half of the cases, it looks like auditors are issuing the correct opinion. For companies that survive, around nearly 16% receive going concern opinions. And then of those firms that do receive going concern opinions, the vast majority survive, right? So it's rare for a company to go bankrupt even after it has received a going concern opinion. So on average, 98% continue to survive even though they've received a going concern opinion. So you shouldn't think of a going concern opinion as like a death sentence to a company. It's really not. The vast majority of companies survive even though they've received a going concern opinion. And one reason for that is just that bankruptcy is very rare. Right? There are only 396 firms that went bankrupt over this 11-year period. Right? And that's much smaller than the number of firms that survive. Okay. All right, so what I'm going to talk about now is how you assess the risk of the company not remaining a going concern. So how do you assess going concern risk? And the auditing standards point out that there are 4 indicators that you need to take into account. First one is what are called operating indicators. The second one are financial indicators. Third one is external indicators. And then the last one is what's called mitigating factors. Now, the first 3 of these are indicators of greater going concern risk, right? So in other words, these are indicating that the company is more likely to go bankrupt, right? The company is in financial distress. The 4th one, mitigating factor, is the opposite. So this is something that indicates the company is more likely to survive and less likely to go bankrupt. It's called mitigating because it means that this factor mitigates or reduces the likelihood of the company going bankrupt. Okay, so what I'm going to do now is run through each of these 4 and describe what these indicators are. What should you look out for as an auditor when assessing the company's going concern risk? Okay, so first of all, operating indicators. The first thing is a company needs to have a clear and effective strategy, right? If a company is going to survive, it needs to have a plan for how it's going to turn around its performance, right? How is it going to increase its sales? How is it going to reduce its costs? It needs to have some clear plan and a strategy. If you find that the company is in distress and it doesn't have that, then that's a stronger indicator of going concern risk. Secondly, a loss of key management. Right? This matters for a couple of reasons. One reason is that if the company is losing key employees, that's just going to make it harder for the company to continue operating. Right? It's losing, people that are running the business. And then the second reason is because if management are leaving the company, then that indicates that they know that there's some big problem there, right? They're jumping ship, like the expression rats jumping, a sinking ship. So if you find that management are leaving, then that could well be because they know that the company is in major financial problems. Thirdly, loss of customers. This is pretty obvious, right? If the company is losing its customers, it's more difficult to survive. If the company is having what are called industrial relations problems, what this means is problems with the workforce, right? So this is quite likely because if a company is in financial distress, it may be trying to negotiate lower wages, or it may be trying to negotiate layoffs for employees. And then the employees, especially if they have a trade union representative, they may then take steps to kind of rebut the company's plan, right? They may go on strike. They may say, look, we don't want lower wages. We don't want to have employees laid off, right? So that's going to make it harder for the company to survive, right? If it doesn't have a good relationship with its employees. Suppliers withholding credit, right? If suppliers get some idea that the company may be financially insecure, then they may decide not to provide trade credit to the company, right? Because they're worried about the company not paying what it owes. And so if the suppliers are doing that, then that's going to make it harder for the company to survive, right? This is reducing a source of financing if they're not getting credit from suppliers. Overexpansion and cash flow problems. So a lot of companies that go bankrupt, they do so because they expand too quickly and they just run out of cash. So this is an indicator. Lack of insurance, right? I mean, that's an issue because if the company has some kind of disaster like a fire or a flood, then that could cause the company to go bankrupt if it's not insured. But also if the company is not paying for insurance, that could be because the company doesn't have enough money to pay for the insurance, which itself is an indicator that the company is struggling financially. And the same thing with hedging, right? If the company is, for example, engaged in foreign exchange markets, it's facing risk because of fluctuations in the exchange rate. It can hedge those risks, but hedging is costly, just like buying insurance is costly. So a company which is in distress may decide not to spend money on hedging. It's trying to save costs, but that exposes it to greater risk because if there's an adverse movement in the exchange rate, it's going to be more difficult for the companies to survive, right? It's raw material costs may increase, for example, or the price of its products in foreign markets may decline. So those are the major operating indicators. Next, we move on to financial indicators of going concern risk. The first one here is by far the most important, right? If there's one thing that you should definitely remember as an auditor, right, you should always check whether a company is going to be able to comply with its loan covenants over the next 12 months, right? Can the company meet the terms of the loan covenants? Because if it can't, if it defaults, then the company is far more likely to go bankrupt. So this is number one, right? Of all the indicators, this is the key one that you should consider. Other ones, high leverage, right? If the company owes a lot of money, obviously that means it's harder for the company to survive. If the company has fixed term borrowings approaching maturity, when I say fixed term borrowing, that means a borrowing that cannot be rolled over. So a company cannot just borrow more money to pay back the previous creditors, right? It has to pay it back in full. And if it's approaching maturity, it means it needs to be repaid quite soon, right? So that's going to make it more difficult for the company to survive. If the company is using short-term borrowings to finance long-term assets, right, then there's a mismatch between when the borrowing has to be repaid versus when the cash is going to be coming in from the asset, right? So that's going to make it harder to survive. So for example, if the company uses a short-term bank overdraft to finance the building of a new factory, right? The factory has a life of maybe say 20 years, right? So you expect to receive cash over a long period, over 20 years. But if this bank overdraft needs to be paid off within a couple of years, then the company may simply run out of cash, right? So if you find a mismatch between the term structure of the borrowing and the term structure of the assets that are being used, or that are being financed from the borrowing, then that indicates a problem. Next one, lack of operating profits. It's kind of obvious, right? If a company is making losses, it's more likely to go bankrupt. If the company is cutting its dividend, or if it's omitting paying a dividend, right? If it's not paying a dividend, then that indicates the company is running out of cash. Because generally speaking, companies like to pay a dividend to shareholders. Reliance on transactions with related parties. Okay, so maybe the company is relying on funding or financing from a related party. Then you have to wonder, well, is that related party going to continue to support the company, right? That would indicate a going concern risk, because if the related party pulls out and says, no, I'm not going to continue funding the company, then the company will probably go bankrupt. And then finally, disposals of core profitable assets, right? So companies will often be tempted to sell off profitable assets as a short-term measure to raise cash. But if those assets are core to its very business, then that's going to make it harder for the company to survive. Okay, so I mean, I'll give you an example. I support a soccer team in United Kingdom called Coventry City, and obviously one of our core assets was the stadium, and the club was in great financial distress, so it decided to sell its stadium. Obviously that led to a short-term increase in cash, but on the over the long term, it meant the club was even worse off, because the club then had to start leasing a stadium from someone else at a very high cost. So it's not a good idea generally to be selling off core assets, right? That is not a good strategy usually in the long run. Okay, so that's the second thing, financial indicators. Thirdly, external indicators, right? So here we're looking at things outside of the company that indicates the company is less likely to survive. So for example, if there's an entry of a successful competitor into a company's markets, right? If the company is losing customers because there's another company that's come in that's just better, has a better product, maybe is more efficient, can charge lower prices, then that's going to make it harder for the company to survive. Maybe the company faces litigation, right? If the company is facing a large court case and it doesn't win the court case, then the adverse judgment may push the company into bankruptcy. So that would be another one. Obsolete products due to technological developments, right? If the company's product line is becoming obsolete because it's becoming out of date, right? The company hasn't kept up with technology, then it's going to make it harder to keep customers and harder to stay in business. Adverse changes in legislation or regulation, right? So if the government passes some new legislation or regulation that makes it harder for the company to survive. So think about, for example, tobacco companies, right? Over many decades now, right? They just keep getting more and more adverse changes in legislation that makes it harder for them to continue selling their products. Companies polluting the environment, right? It's going to be harder for such a company to survive when stricter regulations are introduced that prevent the company from being a big polluter. And then finally, macroeconomic or industry difficulties, right? So, macroeconomic, obviously at the moment, the big one is COVID, right? This is, an external factor that affects the entire economy, not just in the United States, but the whole world, right? And so, this is a very important indicator of going concern risk. And that's why you've seen so many auditors now issuing more going concern opinions to their clients. So those are external indicators. Then on the other hand, we have what are called mitigating factors. So these are factors indicating that the company is more likely to survive, less likely to go bankrupt. Okay, so for all of these questions listed here, basically all these questions are getting at the same thing, right? Can the company delay bankruptcy? Can it try to avoid bankruptcy by raising cash, right? Or by reducing its costs? Okay, so first one here, these are a list of questions you ask yourself as an auditor. Can the company raise money by selling non-core assets, right? Can it raise some cash by selling an asset which is not vital to its business operations? If the answer is yes, that's a mitigating factor that will help the company to survive. Second, can the company delay replacing its assets? Can it lease assets instead of buying them? If yes, then that can help the company to survive, right? It can, at least in the short term, it's going to increase the company's cash flows. Can the company use its assets as collateral to borrow, right? Can it sell some assets and lease them back, right? So again, these are ways of raising cash. A third parties, for example, is the company's parent company, a principal shareholder, or the company's bank. Are they willing to provide more finance to the company? Or are they willing to restructure the company's debt? So for example, if the principal shareholder is owed money by the company and that money is due to be repaid within the next year, is the principal shareholder willing to renegotiate and say, okay, well, you can pay me back over 10 years, right, instead of next year? Can loss-making operations be separated from the company's other business areas? So this is an important question because if they can't be separated, then the company cannot easily close them down or sell them off, right? But if they can be separated, then that's going to help the company to survive because it can just shut down its loss-making operations. So it may be, for example, that the company is losing money because it has an overseas subsidiary which is doing really badly. Well, maybe just shut that subsidiary down or try and find a buyer for that subsidiary, right? That could be one way for the company to survive. Can the company postpone discretionary spending? For example, R&D expenditures, right? It's going to help in the short run, although of course it may damage the company's long-term prospects. Can the company reduce its overheads, for example, by laying off employees? Can the company issue new equity to raise finance, right? So all these questions basically, if the answers are yes, right, then these are mitigating factors suggesting that a company is more likely to survive rather than go bankrupt, in which case you're less likely to need to issue a going concern opinion. Okay, so what are the audit procedures that you should follow when evaluating a company's going concern status? Okay, well, I've listed, some of the main procedures that you would go through here. By far the most important is the first one, which is why I put it in bold and underline this, right? This is absolutely critical. You need to find out, as the auditor, if the company is in compliance with its debt and loan agreements. If the company is not complying with those loan agreements, then it's much more likely that the company will go bankrupt. Okay, so you need to check the agreements the company has with its bank, right? Is the company complying with the terms of the bank loan? Because if the company is not complying, then the bank can just demand immediate repayment, right? And that is often what triggers the company filing for bankruptcy. So this is by far the most important one, right? Secondly, you need to assess the feasibility of management's plans, right? Of course, this is a little bit difficult because, of course, management will try to convince you that, you know, we've got amazing plans, we know what to do, we know how to improve the situation. But if it's the same management that got them into the mess in the first place, you have to ask yourself, well, is this really credible, right? Do they really know what they're doing? Thirdly, identify and assess post-balance sheet date events, right? So any events occurring after the year end could be quite significant. So if you think about, for example, a company that had a December 31st year end in 2019, right? You may have been auditing that company in, say, March of 2020, and that's the time when COVID hit and, you know, we're moving towards lockdown. So that would be a post-balance sheet date event, which would obviously have very significant ramifications for the company's future, right? So you need to consider these kind of post-balance sheet date events, things occurring after the year end that affects the company's financial health. Perform analytical procedures on the company's most recent accounts. So in question number 1 on your seminar outline, you've got some practice in using accounting information to assess a company's financial health. Read the minutes of meetings held by the board, stockholders, and board committees. So this is important for a couple of reasons. First of all, at those meetings, the company will be discussing how it intends to improve its performance. So you'll get to learn about the company's strategy. But in addition, you'll also find information about whether the company is going to receive continued support from stockholders and, you know, from its bank, for example, right? So those kinds of issues are going to be prominent, right, in the meeting because, you know, if the company is in financial distress, that's what the company's focus is going to be on, right? So read through the minutes of meetings to find out what has been going on during the year. Contact the company's legal counsel about litigation, right? Find out if the company is being sued, particularly if it's being sued by suppliers for non-payment, right? Because sometimes it's the suppliers who put the company into bankruptcy, right? And they demand immediate repayment, and then the company files for bankruptcy to get protection from the suppliers. Okay, so contact the legal counsel to find out if the company is being sued, and if so, for how much. Review account payables for difficulties in paying suppliers. Again, you know, if the company is not paying its suppliers on time, then suppliers are more likely to try and sue the company to get payment. And in addition, suppliers are less likely to provide trade credit to the company, which is going to make it harder for the company to survive. Contact related parties and third parties about their willingness to provide financial support. So by related parties here, it's primarily the company's major stockholder, principal shareholder, right? Is that person willing to continue providing financial support? Third party, primarily here, we're thinking about the company's bank, right? Is the bank willing to continue lending to the company, right? So contact them, and then if they do promise financial support, especially if it's coming from a related party, you have to consider, is this promise realistic, right? Because a parent company may say to the auditor, yeah, don't worry, we'll support this company, we'll continue to provide finance. But of course, they may be saying that because they don't want to get a going concern opinion, because if they do get a going concern opinion, then that could cause, for example, suppliers to stop providing trade credits to the company, okay? So you have to bear in mind that the parent company or controlling shareholder may have biased incentives, right? They may be motivated to not tell you exactly the truth, right? They may tell you that they will provide support when in fact it may be that they don't really intend to, okay? So what should you do? Well, you should make sure that any promise of financial support is written down, right? So will the parent company, will the controlling shareholder provide written confirmation of the promised financial support? So that's important because, if the case goes to court and the court says, well, why did you not give a going concern opinion? And you say, well, it's because the principal shareholder promised to continue providing financial support. That's going to be a lot more compelling if you can provide the letter from the company where they made that promise, right? Otherwise, it's kind of hot air, right? So try and get written confirmation. And then also you should think about what are the economic consequences to the owner from providing financial support. In other words, if you were the owner, would you continue to provide money to this ailing company, right? Would you want to prop up this company by giving it more money? So put yourself in the position of the owner. What would you do, right? Do you think this company is a company that's worth bailing out? Or do you think this is a company that the owner might want to close down, right? So yeah, be skeptical, in other words, right? It may be that a controlling shareholder or parent company says they will provide financial support. You need to think, well, is that really going to happen? Yeah. Is it in the interests of the principal shareholder to do that? Okay, that's where we're going to end today's video. When we get to the class, we'll make a start, first of all, on question number 1, which is ABC company. I'll ask you about the key indicators of going concern risk. What are the limitations of using analytical procedures to assess going concern? What additional information would you like to have to evaluate going concern? What are the risks of material misstatement in the following accounts? And then what do you think about the CFO's offer to increase your audit fee? Okay, thank you for watching.